Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're discussing what you need to know regarding tax implications of 401k rollovers. Now, this is a really big topic right now because many of you viewers probably have participated in the Great Resignation, leaving the workforce en masse. That's what we've seen, or upgrading their jobs to one that has better benefits or more pay.
Yeah, Michelle, we've seen a huge uptick in 401k rollovers because of this Great Resignation going on. We've talked about this in many of our other videos, but it's so important to understand the rollover types and the tax implications of each before you make that move. So think about this, Michelle. The amount of taxes you will pay all comes down to how you roll over or withdraw your funds. Each has its own implications, so you need to be careful out there.
Yeah, for sure. So we've dropped in some of our top 401k rollover videos, links in below the description. Make sure you check those out after you watch this video. And while you're at it, go ahead and like the video, help us grow the channel. And also don't forget to subscribe so you don't miss another video from us. All right, so let's dive into the tax implications of 401k rollovers. What do we need to know?
Okay. First, Michelle, before we go to that section, it's important to define the two types of rollovers that are out there, okay? Direct or indirect. And let me explain them real quick. So in a direct rollover, Michelle, a 401k direct rollover occurs directly, that's why it's called direct rollover, between the trustee or the custodian of your old retirement plan and the trustee of your new plan. You never actually receive the funds or have control of them. So a trustee to trustee transfer is not treated as a distribution here. And you can directly roll over to an IRA, a Roth IRA, an annuity, or even your new employer's 401k plan. Okay.
Okay.
So then we got the indirect rollover. With this type of 401k rollover, you actually receive a distribution from your retirement plan. And then you've got to complete the rollover transaction, meaning you've got to make a deposit into the new retirement plan that you want to receive the funds. You have to complete the rollover within 60 days of the date the funds are paid from the distributing plan. If you fail to complete the rollover or miss the 60-day deadline, all or part of your distribution may be taxed and subject to a 10% early distribution penalty unless you're age 59 and a half or another exception applies.
Yeah, not good.
Not good. So there's the two types of rollovers. Let's get into the tax implications.
Perfect.
Okay. Now, taxes are due on every withdrawal from your 401k. This will be counted as normal income in the year you withdraw the funds. So normal income, it gets added to what you've made during the year. So if you made $50,000 during the year and you took out a $10,000 withdrawal from your 401k, your income is now $60,000 for the year, right? $50,000 plus $10,000. So just remember that. And you're taxed on all of that, which could lead you in a higher tax bracket. So now, taxes are not due on a direct rollover from your 401k to an IRA account, your new employer, or whatever it may be, if it's a direct rollover. Since it's going from transfer from custodian to custodian, no tax consequences.
Okay.
This is our preference treatment of a rollover. Use direct. So anyways, next, taxes are withheld from every indirect rollover of 20%. This is huge. So Michelle, if you do an indirect rollover, let's say you say, I'm working at this company, I've left them, I've got my 401k, and send me the check and then I'll reinvest it in 60 days. Yeah, right. Well, you get it. Guess what? Your custodian is mandated by IRS to withhold
that 20%.
So on 50,000, they withhold $10,000. Okay. After the taxes are taken out, you are going to be sent the remaining funds by check. This means that if you want to roll over your entire distribution, you need to come up with that extra 20% from your other funds like savings account, checking account. And at the end of the year, you'll be able to recover the withheld taxes when you file your tax return. So
got it. Yeah. So I'm going to just recap here. Number one, well, what you just said for the indirect, which is, I mean, people can get really hurt by this, right?
Yes. Yes.
Taxes are not due on a direct rollover from your 401k to an IRA or something like that because it's transfer custodian to custodian, no tax consequences. And anytime you withdraw from your 401k, it is counted as normal income.
You got it.
Okay. All right. So, I mean, really, I guess the key here is to be careful, plan your strategy wisely because taxes can take a huge bite out of your rollover. If you're not
about the taxes.
Right. Yeah. And not even a huge bite out of your rollover, out of your retirement income later on.
Yes, definitely.
So, all right. Okay. So we're going to wrap this up, but you can see all of this works. We've download below this video. It's called 11 must answer 11 must answer questions before you make a rollover move. And this is really important. So the link below is that. And also we have got our other rollover videos below in the description.
Definitely.
All right. Anything else you want to add before we wrap up?
No, just be careful. Just be careful. Follow us. You'll be able to get the true answers before you make a move. So
hit that subscribe button. Make sure the notification all bell is on. And don't forget to hit that like the video. There you go. All right. Thanks, Brian. And thanks everyone for watching.
Thanks, everyone. Have a great day.